You might be sitting here and saying, Ruben, what is the macro solar system? The sun is in the center, but all these other things here, these are key elements that make my strategy profitable. Ultimately, today we're going to focus on a few things: low resistance liquidity, high time frame fair value gaps, impulse, and if I just move my head, the last thing is going to be inverse fair value gaps, because these things are what govern my macro model. And these are the things that make it high probability. It's as simple as that. Straight into it, guys, we're going to talk about planet number one. And planet number one here is going to be the higher time frame fair value gap. A lot of people ask me, they have the question, what higher time frame are you talking about? Are you talking about the 1 hour, the 15-minute? And I've given a definition here for each of these planets. So each of these planets is just as important as the other. So I've defined it here saying a higher time frame fair value gap is, for me, one that's seen on the 5-minute or the 15-minute chart. And don't worry, this PDF, if you're still watching, it'll be in my free Discord. Check out the link in the description below. Just send me a DM, I'll send that to you, no problems. And these are the 2 dot points that you need to write down. These are things that you should study for yourself that will give you the confidence to implement this model. Number 1, we're looking for price to find either support or resistance at these areas. Keep it simple, guys. Keep it really simple. Say, for example, price does this and it taps into a 15-minute FVG. I'm looking for that to find support. And the same on this side, if price does this, it taps into a 15-minute FVG during a macro. I'm looking for it to find some kind of resistance. So that's the first point here. You're looking for price to find support or resistance at these key areas. Keep it simple. And number 2, you're looking for a reaction around a macro time frame. Any macro, whichever macro lines up with a higher time frame, that is the one that's going to be high probability. Keep that in mind. So that's planet number 1, and here's an example for you guys. This here, you can have a look at the bottom. You can see I've drawn out this 15-minute FVG, and price actually comes into that here and finds some kind of support. So at this point, we're looking for longs. Why are we looking for longs? Because we're treating it as support and resistance factors. Again, down the bottom here, there's a macro. We'll talk about that as time goes on, but we need more than that. We can't just wait for price to come into a gap and automatically long or short. We need more confirmations. And this is where planet number 2 comes in, which is low resistance liquidity. Now, a lot of people ask me, what is low resistance? How do you look for it in the markets? Are there different types? Are some types better than others? We're going to talk about it today using this example. So I've defined it here today, guys, as relative equal highs or lows, or the highs or lows that form a trend line. Let me illustrate it. So for example, say you got the market doing this. Price is stepping down, 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 down. This is what I call low resistance buy side liquidity. It's trend line liquidity. It's all nice and trend line. And if we tap into a 15-minute gap here during a macro, I'll be looking for a reversal. Keep that in mind. The same thing would apply if we form a swing high here, a swing high here, and we trickle back down into a 15-minute gap. That's low resistance, trend line, and that's low resistance, relative equal highs. I'll be looking for a long position. Now, onto these dot points. Dot point number 1, planet 2. The more that is generated, the better. So if we generate this low resistance for 5 hours, it's much better than generating it for 20, 30 minutes. However, time is fractal, price is fractal. So if we see price do this over a long period of time, I'm expecting a move up that's very quick. If I see price do this and then tap into a PDRA, I'm expecting price to move quick to these highs. So whatever highs or lows are low resistance, those are the liquidity points that I expect. As I say here, I expect a quick move through these points. Now take a look back at this example and keep these 2 points in mind, right? The first point says the more low resistance, the better. And the second point says expect a quick move through these areas of liquidity. Now let's pair the 2 and 2 together, right? Back to planet number 1. Planet number 1 was a high time frame fair value gap. We've got that right here. That is our 15-minute FVG. You can see 15-minute time frame. Planet number 2 is low resistance liquidity. So we're combining the 2 now. We've got a 15-minute fair value gap, we've got a macro, and we've got this low resistance liquidity. Now, can you see how we've got these highs very close together, and then this high, and then this high? There's stacked low resistance. So we expect a quick move through those points. And do we get that? Yes. But the question you might have is, well, how do you enter, Ruben? How do you enter off these trades? Like, what's the framework that governs this? Let me show you. Planet number 3 here is impulse. We are looking for impulse to happen in the market. But what is impulse, you might ask? Well, say for example, price does this. Price does this, taps into a 15-minute FVG. I do not want price to just muck around like this. I want price to tap into that fair value gap and reject sharply from that point. It's a sharp reaction with big green or red candles, depending if you're going for a long or short, and you're looking for these things to happen away from a higher time frame PD rate. So we expect multiple points of impulse towards that low resistance, and we'd also prefer to see impulse away from a high time frame PD rate. Write this down. All these points, guys, write these points down, and please, I encourage you, go back into your charts, find more examples of this happening. It happens in the Asian session, the New York session, the London session, every single session. If you haven't already, check out a video in the link in the description. It's how I trade macros, right? Using this combination of factors. And on top of that, I just went live actually for free on YouTube. Check that out. We talk about these 4 planets, these 4 structural points live in the market during the Asian session. I'll leave a link also on the screen here. I'll put a snippet just so you guys can check that out. But what is impulse? What does impulse do? What's it show me? What's it show you? Well, impulse indicates movement. Write that down. Impulse indicates movement. And impulse allows the lower time frame confirmation from a higher time frame PD rate. Let's talk about it. So having a look here, this is that 15-minute FVG. Anytime we have impulse away from that, we can look for trades. If they happen during macros, even better. So there's a long position here, a long position here, but the one we're talking about today is a long position from here. And look at the screen, look at the chart. We dig back down into that 15-minute gap, we mohawk on the end, and then we have impulse back up. Impulse, green candle, green candle, green candle, green candle. And in doing so, this leads us to planet number 4, or structural point number 4, which is the inverse fair value gap. The most important confirmation once all these other things line up. Now, a lot of people ask about inverse fair value gaps. You know, what if you got multiple fair value gaps? What if there's only one? Do you have to see a full body closure? Well, let's combine the two, right? It's better if the inverse is created from impulse. If not, you need to wait for more confirmations. But all it is, it's a fair value gap that's disrespected when price closes above or below. What does it change? What does it indicate for us? Well, number one, it indicates a potential shift from one direction to another. That's important. And number two, the most important thing here is that this is the entry signal. This here is the entry signal. So you have price tap into the 15-minute gap, tick. You have low resistance to target, tick. You're inside of a macro, tick. You have impulse on the inverse fair value gap, tick. You take the trade. Let's get into it. So here's the example here. You can see we have all this accumulation. We form low resistance buy side, relative equal highs, and trend line liquidity. We push down into the 15-minute gap. We have impulse out from that. That's great. We have low resistance. We have a higher time frame FVG. And down the bottom here, guys, this is 450 macro to 510 macro. The reversal happens during the macro and the entry comes from this inversion. Perfect. Again, this is the entry signal, but we need to have other confirmations to take this trade. Now, it's not just today that this happens, guys. We could go back to the charts today during the Asian session. And I'm going to show you exactly how this plays out using exactly the same framework, different day, but same methodology. All right, so let's take a look at the charts here. This is what I called out live in my last live tape reading session on YouTube. Check that out. But ultimately, we can see here, right, there is a 15-minute fair value gap. I'm on the 15-minute chart. So again, go back to that same philosophy. Planet number one is the 15-minute FEG. That's right here. Planet number two is we need to have low resistance, right? Let's go back down to see where that low resistance is. We'll talk about it. So planet number two, we need to have low resistance. You can see here we've got two relative equal highs right there. So that's low resistance. Price taps into this 15-minute fair value gap. When does price do this? Have a look at the bottom. I'm going to mark out a macro. Now, this is the Asian session, but you saw an example of how this plays out during the London sessions. That's 950, and then 1010 is right here. What's the next step? We need impulse. We need impulse, and we need an inverse fair value gap. Well, there's multiple. Number one, we have this. That's an inverse. And see how impulsively we close above? That's an option. Or number two, you wait for this one. That's impulse, and then you enter. So regardless of how you trade this, you're looking for these four things to have a high probability trade framework. And you're going to see great success with this if you follow this pattern and model. This is what I've been teaching for months and years, both for free on YouTube here, but also in the Discord. And I thought today, what better way to do it than to summarize it in terms of the macro solar system, because this is an easy way to remember it. Think of the macro as the sun. But all these other bits and pieces are just as important. You need all these things to line up to take a high probability trade framework. How do you enter, right? Long can go from here, stop below the inverse. You can take a 1-to-1. You can take a bit more, a 1-to-1.5, or 1-to-1.4. But this is the model. Again, we look at those 4 planets, we determine what we're going to do, and then we execute if we have that inversion fair value gap created. And yes, you can enter just outside the macro or just before. Keep that in mind, that's completely permissible. And to conclude this video, guys, planet number 5, the most important is the journey. Everyone is on their own journey, right? Everyone learns at different rates. You can't expect to compare yourself with someone that you're close to or someone you know on social media, because everyone learns at different rates. Everyone succeeds at different rates. Everyone has a different amount of time to put into the markets, but you'll now need to embark on your own journey. Take the spaceship, hold on, right? And enjoy the journey, enjoy the process, because again, you're going to discover how different mechanics of the market can work with macros. Number 1, you've got to ask yourself questions. Ask questions. So when price taps into a 15-minute fair value gap, how often does it find support there? How often does it not find support there? And then answer these questions for yourself. How are you going to answer these questions? Take screenshots, use chart time, back test if you need to, right? And collect data, number 1. Number 2, aim for a 1-to-1. Stick with a 1-to-1 and then experiment. Get comfortable with this and then experiment holding runners. And number 3, understand that this framework can work in all sessions. I've traded all sessions using this framework. I've become profitable using this framework. And remember back to the macro solar system. Whenever you think about taking a trade, remember the macro is the core element. It's like the tree trunk. The branches or the planets, the external factors that are still just as important to take a good trade. They're these things, right? Low resistance, high time frame fair value gap, impulse, and the inverse fair value gap. I hope you guys got something from this video. I want it to be straight to the point, but I want it to be something that you can actually use to go and implement and chart study for yourself outside of this video. So use everything you've learned in this video, write down all those dot points and find these things for yourself in the session that you trade. Again, guys, if you want access to the summary PDF that we've just gone through, join the free Discord, send me a DM. I'll see you in there. Have a great week. Peace out.